All right, welcome back, and thank you for tuning in to episode 12 of the Cash Flow Corner. Excited to have Ryan Watts from Red River Development on today, and couldn't be more thankful for you spending some time with us today. And I guess I'll just kick it right to you. How are you doing today?
Hey, thanks, Aaron. Doing great. Doing great. Yeah, good to be with you guys. Yeah, doing well.
Yeah, I know, Ryan. We're super excited to have you on. Thank you for taking some time out of your day here to be on the podcast. Can't thank you enough. And I know Aaron and I were looking forward to having you on. That way, our investors, our listeners can learn a little more about you and your company and what you guys are doing on your end. So, yeah, we're super excited to get this conversation going. I'll kick it back to Aaron if you want to lead the discussion here and ask the first question as we kind of kick this off.
Yeah, I guess the first question would just be if you just want to give yourself a brief introduction, not only about yourself, but Red River Development as well.
Yeah, happy to. Happy to. So I co-founded Red River Development in 2020 alongside two other partners. One of those partners is Jay Dempsey. So Jay has an extensive background in senior living, has a company called Civitas Senior Living, still a large going concern. 2,500 employees. They've done close to $1 billion in ground up development, have 38 active senior living communities in that portfolio. And then my other partner that I co-founded the business alongside is Stephen Watts. Stephen happens to be my brother. Obviously, we share the same last name. He's got a background in construction and project management and multifamily development. And so, back in 2018, 2019, Jay and I were investing in some of Stephen's deals, and we were talking about during that time build to rent and the idea that, hey, this is a big emerging asset class, kind of a subsegment within multifamily that we felt like was really had a long runway to it, and that we'd seen the product get developed a little bit in Dallas, in Phoenix, and we saw a lot of room in the market to go develop this product, and so. My background, I've always been an entrepreneur. I actually had an oil and gas investment firm, and I exited that business in 2020. And that's kind of what freed me up. We were all kind of sitting there right in the heart of COVID and talking,
Yep.
Everybody had a lot of time on their hands at that point, right? And trying to think about, hey, what's next? And so we said, hey, let's form this business to really invest behind build to rent. And so fast forward to today, we've got about 1,500 units under management, about close to 500 million in AUM, and we've built a BTR brand called Trulo Homes. So if you Google Trulo Homes, that's TRULO, you'll find our communities there. That's kind of our resident-facing brand or customer-facing brand for our property management business. So we do manage all these communities ourselves. So we think that's important, for execution. So, but that's the background and kind of how we came to form Red River Development.
Yeah, that's awesome, especially hearing how you partnered up with your brother. Funny enough, doing the same. So always interesting working with your brother and family. But just your career as an entrepreneur and just continuing to grow, of not being in a specific mindset of staying with oil and gas, but continue to grow and develop, I think has been our biggest thing of just continuing to grow each day. I know we always think we have different plans, but trying to figure out what works best for us and then keep moving from there. And I think that's the best way as an entrepreneur to really continue out through your investment career. And I guess from there, for our listeners that may be unfamiliar with build to rent, could you explain to them really what that is, how it differs from traditional multifamily or apartments, and just take it from there?
Yeah, happy to. So with our Trulo Homes communities, we're really trying to give our residents the best of both worlds between a suburban rental home and then the amenities of a new built Class A multifamily community. So, on the amenities side, we have a large clubhouse, we have a resort style pool, 24-hour fitness center, a very well equipped gym. We've got community spaces in that clubhouse that our residents can rent. We've got dog parks, green spaces, oftentimes playgrounds, bocce ball, It's a gated community. So we have on-site maintenance and on-site leasing. So really, we handle all the maintenance for these homes. And then, it really lives like a home for our residents. So they're all single story. The twos and threes are always unattached. Sometimes we'll duplex the ones. But each home has their own private backyard. Our residents get out of their vehicles, they walk to their front door, so they don't have anybody above them or below them. So different than traditional multifamily in that sense. Also, the way that we build these things, we build them in phases, right? So you think about a multifamily building, you're not going to get a CO until the whole building's done, right? And so we can do that faster with phases. Typically deliver in a first phase in month 14, which I think really helps accelerate lease up. And then I think what we find is that the tenants are stickier. They stay about twice as long, 2 to 2.5 times as long as a typical multifamily tenant. And I think you've got a better ability to drive rents, with a product like this. It's a differentiated product. It's in demand. There's certainly a lot more supply of garden style traditional multifamily in most all of the markets that we're in. And so I think your ability to grow rents here is better also.
Yeah, no, and the one thing that Aaron and I, we were pretty unfamiliar with the BTR, the build to rent, model in that space until we actually connected with you and started, doing our own research, taking a little deeper dive. And for me, what I thought was really cool, and the thing that Aaron and I can definitely resonate with, is our generation of, kids that are starting to get into the business professional world of trying to establish themselves and really try to purchase a home by themselves. And I feel like the build to rent model really starts to help out that generation of being able to give them access to something like that, where they can, maybe settle down and transition into something like that. And then a couple of years down the road, then they can find themselves purchasing a home or whatever that looks like for them. But I feel like that's something that stuck with us. And that kind of leads into my next question for you here, Ryan, about the current trends that you see with the build to rent model. Is that a little different from the multifamily space? What are you starting to see right now within the build to rent market?
Yeah, good question. Jacob, you hit the nail on the head. Talking about demographics, and that's our biggest cohort, right? Is young professionals that are transitioning out of apartments. They may not be ready to buy a house yet, but maybe they've got a dog, maybe they're starting a family, but they want something that lives more like a home. So that's a big cohort. Median priced home in the U.S., just principal and interest right now, is about $2,900 a month. That doesn't include property taxes and maintenance and insurance and all the other carrying costs that come along with home ownership. So we're providing a really good value proposition. Our chunk rents are usually around $2,000 a month or a little more, and that's a really good price point when you compare that to the cost of home ownership. So the goalposts have definitely moved. We all saw that happen, and during COVID and in the years afterwards, as inflation was running, and those home values, while the rate's not growing as big as it was, it's hadn't gone down. It's
Yeah.
still up there, and so. And then also on the other end of the spectrum, trend that we see is a lot of empty nesters and folks that have raised a family in a suburban community. That maybe they want to be closer to the kids or the grandkids, but they don't want to deal with the maintenance of a house. They're well off. They could afford one, but they don't want it. And so we take care of all their maintenance. We give them a nice new built product that with high ceilings, and it really feels like a home. And so for a lot of that's really our second biggest demographic, and those folks really love the Trulo Homes product.
Yeah, and I think that's something where, honestly, our parents are kind of in that same boat. Both are divorced, so they're kind of on their own, but we have a brother in Pittsburgh. We're obviously out here in Scottsdale. So it's something where they're looking to try to get either closer to Pittsburgh, closer to us, and it's something where they want to be able to move and not be tied down to something, so that they still have that flexibility going forward with however they want to, see their lifestyle pan out over the next few years. So I can definitely resonate with that.
Yeah, absolutely.
Yeah, then following that up, especially what Jacob was saying, I know how you mentioned maybe kids or parents want to be closer to their kids, or just want to downsize, get out of the house they're in, just take that relief off of maintenance, like you mentioned. Are there any specific areas geographically that you've seen that you're trying to identify as emerging markets, or certain areas that you and Red River are particularly focusing on?
Yeah. So we've been a first mover or a fast mover in what we think are really strong secondary markets. You've seen this product get developed a lot in Dallas and Phoenix, like I mentioned, in Austin and, in Tampa and certain areas, what I would call kind of the top tier markets with the highest kind of growth rates. So what we chose to do was to go to that kind of next tier of markets that have good, strong, steady growth, and have great fundamentals, but maybe aren't quite as competitive. And we felt like by doing that, we could get closer, more infill sites, and we could really be the first to deliver this product in those markets. So that's taken us to markets like Indianapolis, Kansas City, Bentonville, Arkansas, Tulsa, Oklahoma, Oklahoma City. And we've seen those communities do very well there. We've got Trullo Homes communities in all those markets, and we're seeing them perform well. And then as we look ahead to the pipeline, our next community is in Centerville, Ohio, and that's in the Cincinnati-Dayton MSA, really about an hour and 45 minutes east of Indianapolis. So that's a market we're excited about, and we like that upper Midwest area. Both Cincinnati MSA and the Indianapolis MSA are markets we really like.
Yeah, especially two guys from the Midwest, just South Detroit, Michigan. I mean, we, especially going to college up there, we have a lot of connections with the Midwest, and I know it's always an emerging market, and especially kids that are just getting out of college, they tend to really stay in the Midwest. If you're from the Midwest, I know we're kind of an outlier of moving out here to Arizona, but most of our friends and a lot of people that we know are definitely tend to stick around in the Midwest. So love that strategy of focusing on those secondary markets. And then going along with that, I would say, what is the development process for the build to rent projects look like? And what would you consider key factors that make a build to rent project successful?
Yeah, sure. Couple of things there. I mean, from our standpoint, we're typically putting land under contract, right? That's raw land, and more often than not, we're having to do some kind of zoning work. The easiest thing is probably to find multifamily zone land and then create a PUD for our specific use. Planned unit development. That's a term that a lot of cities use. Because because this is a newer product type, there's not often like an off the shelf zoning like you would have for garden style multifamily or townhomes or something that has been built a lot. So we're going to do that. We're going to do design. We're going to do engineering work. We're going to spend typically 9 months to a year before we get to where we're closing on the land, and then not too long after we'd like to be breaking ground on a community. So, for us, our typical communities are usually around 200 homes, give or take. And we think that's a really good size. Our business model and what we see, and I'm sure you guys see this too, there's been a lot of institutional capital raised and focused on this asset class. And that's really happened a lot in the last, even the last 5-10 years. And so when we look to exit this, we think, hey, having a community of that size and scale, that's very attractive to those institutional buyers. So as we build these and lease them up, and then eventually look to exit to generate returns for our investors, we think that having that scale is important. These are fairly large projects. Total capitalization is typically around $60 million, give or take. But we think that's a real good sweet spot in the market.
Yeah, I agree. And especially like you mentioned, those larger institutional companies, the Black Rocks, who, I mean, it's been in the news the last few years of they're just buying up these large communities and homes and stacking them together in portfolios, and it almost just adds up to a perfect storm, like you mentioned, to build these up, get the rents, get them running, and then almost just hand them off because they really don't care what they're paying. They really just want to they want them and they just want to hold on to them, which is kind of crazy to see. But I think it's a beautiful strategy. And then going from there, I know you mentioned the capitalization is normally around 60 million, and then from there, I would say, what kind of returns do the build to rent projects typically see generated throughout the lifespan of the
Yeah,
deal?
yeah, yeah. So we're looking to generate returns in the low to mid 20s, 2x multiples on invested capital, and we build, as I mentioned, we build these in phases. Total construction periods usually around 30 months, but again, we're going to start leasing in month 14, 15. And then by the time that construction's finished, I'm sorry, the construction's about 24 months. We would hope to be fully stabilized at 30 months. So by the end of month 24, we're 70, 80% leased. We're pushing to lease up the rest of it and then hit stabilization there around month 30. So at that point, we're going to make distributions to our investors and would look to high single digit, low double digit kind of yields. And then from a capital structure standpoint, we like to be conservative with our debt structures. So we've typically done 65% loan to cost bank debt. We usually personal guarantee that too, which helps us get better terms. And I think speaks to the fact that we believe in this stuff too. And, by doing that, sometimes you'll see guys that want to put, a lot of pref equity on a deal or something. And yes, that can juice returns for the investor, but it can also create a much higher risk of capital loss. And so for us, structuring these this way, it allows us to, hey, if we want to hold it a little bit longer because we think we can sell for a better price in a year or two, well, hey, we'll just keep clipping the coupon and making those, 8, 9, 10% distributions to our investors. And then, wait for the right time to sell versus being, kind of forced to do that.
Right. Yeah, no, that makes sense. And, that's kind of the next question I want to hop on and kind of goes off of that. Just being able to talk about the risk and everything that goes into the risk of investing into the BTR model. And really for our investors and our listeners here, Ryan, what are some of the risks that people should be mindful of when, comparing them to other investment class types, and what should investors really be looking out for?
Yeah. No, great question. I touched on it earlier, but I think a big one is just capital structure, right? I mean, the fact that we have a conservative capital structure, that's going to give you the most flexibility, and it's going to minimize that risk of a loss. When when you're raising, it means we got to go out and raise more equity. But at the end of the day, we think that's a much safer thing for our investors and protects returns and protects downside in a big way. I mean, the other thing that I would say is just look, track record's important, right? And the team that you're investing with is important. We've got a little bit more than 30 people. We've got strong development team. We've got a strong property management team. We built 5 of these communities already. We've leased them up. We know how to operate them. Having that history and track record and being able to show, actual performance, I think is really important. Working with great construction partners and having good relationships there, and then making sure you're getting a guaranteed max price contract to really lock that price in, right? So the cost plus can be pretty dangerous if all of a sudden costs start running, it can throw your returns off track, and could potentially create a need for capital calls. So we always do a guaranteed max price contract, and our deal in Centerville that I mentioned, that's kind of the next one up. We actually have a partner who's based in Indy there, so they give us really good regional boots on the ground. They build for us in that market. They're building for us in Indianapolis right now. Have done a great job there. Honestly, it's been our easiest construction project. So that is an important thing too. And then the other thing I think that we see as a real advantage is, finding somebody with an integrated business model, right? A developer, but also somebody who knows how to manage these properties. Your ultimate return and realized returns are greatly impacted by how well these properties get managed, and are you running a good OpEx margin? We're really good at keeping a good margin. We're cost conscious, much more so than a third party property manager who those guys just want to get in there and lease it up and get paid their leasing bonuses and get on down the road, and are less concerned, I think, about really optimizing operations. So we think that's also a big advantage and an important risk to manage when it comes to generating the actual returns.
Yeah, and I think that's almost exactly what me and Jacob try to talk on for our listeners and for our investors a lot is whenever you're looking at deals or you're out there networking, it's all about having good partners and having that expertise in their fields. I feel like helps a lot, like you mentioned. And it's almost just turns into that rinse and repeat where you've done it before, what what the challenges are, how to overcome those challenges, what might come up, and just being aware and confident in each deal that you're going into, I think makes some of the biggest differences and gives the investors just more confidence going into each deal as well. And I know you briefly mentioned it, but if we want to go forward about the Centerville deal in Ohio, if you just want to tell us more about that and really how it compares to past deals that you've done and what the differences look like, if there are any, or if it, again, just kind of looks like another rinse and repeat.
Yeah, certainly. We love that Centerville market. It's about from Centerville. That's a southern suburb of Dayton, kind of northern suburb of Cincinnati. It's about 40 minutes to downtown Cincinnati, 20 minutes to downtown Dayton. It's a very high income community. So this is really the highest median incomes of any community we've built in. It's 175,000 in just the surrounding 1 mile area, which is very strong and I think speaks to our ability to not only to hit the rents that we want there, but to maybe even push rents in a greater way too. When we look at a site, first of all, we're settling on a market that we like. We love the Cincinnati-Dayton MSA. But we're also looking at kind of key demographic factors, right? What's household growth, income growth, job growth, household occupancy, median incomes I mentioned already, very important. Rent to income ratio. We're looking at home values, school districts. Those are all, and then also just proximity to job centers and where are you located? How quickly can you get around the metro and get to where people are working? And Centerville checks all those boxes and lines up very favorably with our other communities. If you stack them side by side, it's right there or above in most categories. And so, we think this one lines up very well and very comparably to the previous communities we built.
Yeah, I like that idea about, diving in a little more about the demographics within that area. And it definitely sounds like there is an appetite in that area for, a project like this. So I could definitely see that, working out based on what you said there. And just a little more, I want to go into, just kind of taking a deeper outlook at Red River's development of the long-term growth of what you guys are expecting to do over the next, let's call it 2, 3, 5 years of, what investors can expect from you guys as you guys push forward.
Yeah, sure. So, we've talked about Centerville. We own 2 other sites today. One is in Waco, Texas, and another one's in Kansas City, Missouri. So those are both really great sites that we're also excited about. And so I think our near-term focus as a firm is to let's get Centerville capitalized. Let's get Waco capitalized. After that, that'll kind of come after Centerville. And then Kansas City will kind of come behind that. And I think once we get those next 2 deals done, we'll look to kind of backload the pipeline and add some more sites. We think there's really good locations in some of the markets we're in already. We talked about Kansas City, we talked about Indy, Bentonville. Those are all markets we love and would look to do more in those markets. So I think as we've refined this business model, we're excited about continue to grow and scale and deliver this True Low Homes product to these markets. And, as we said, we've seen residents really love the product and have really resonated with it. And so we're excited to do more. We think there's a lot of white space out there. We're still in the very early innings of build to rent. If you look at it as an overall kind of asset class, this is still a very relatively new asset class. And so we're excited about the opportunity in front of us there for sure.
Yeah, I completely agree because, like we mentioned earlier, with just home prices constantly increasing and then interest rates still pretty high. I just know me and Jacob can attest to the younger generation of not even really wanting to go out and buy a home. They just feel more comfortable renting because of points that you've mentioned of not having to really worry about maintenance, or if something goes wrong with the house, of not having to really deal with it and having that property management team there to have your back. For a lot of the younger generation is really what they lean towards and what they want to do. And I know for the older generation, it always used to be, oh, your home is your best asset, and just want to continue holding on to that and build up. But I feel for us, at least, we're trying to connect with more people out there that are helping them realize that it's not really an asset. It's more of it's really your biggest liability. And you can put money towards deals like this that are going to end up building an investment career throughout your lifetime. And it's going to be that wealth building step that just continues to grow, instead of almost putting into like a money pit of just continuing to update the house, do something, or something goes wrong. It's almost never ending. So I definitely see this asset class of build to rent really exponentially growing throughout not only the future but the near future as well. So excited for that. And then I guess just what would your takeaway for investors be to really, what do you want them to take away to understand what a build to rent investment looks like, not only for today but really going into the future?
Yeah, I think we touched on a lot of it. I mean, I think the fundamentals are still very, very strong for build to rent. We've seen great performance in our communities, and that's been a big validation for us, right? I mean, we've seen, as an example, our community in Tulsa is fully stabilized. We leased up and had 20% higher rents than we pro forma. We leased it up faster. I mean, it basically outperformed every metric on the pro forma, outside of interest expense. And the good thing is, you've seen where we are in this market cycle. The interest rates have climbed up, right? Now they're finally starting to cut and head the other way, but it's really slowed down the development pipeline. You've seen a lot fewer things get built. They're still trying to, in the markets like we touched on, the super white hot markets of Dallas and Phoenix and Austin, they're still trying to swallow a lot of new supply that's getting delivered right now. But what's coming in front of it has slowed down. And I think what you've seen too, in a lot of the markets that we chose, because we felt like, hey, there's not as much supply hitting those markets. Now you're seeing those markets be in the top 5 in rent growth in the United States. When you look at markets like Indianapolis and Kansas City and Cincinnati, those are all posting really strong rent growth numbers still in this environment. And I think a lot of that's just attributable to the fact that they didn't have the supply glut hit them like you saw in some of those big primary markets where all the capital was trying to run to. So overall, I think we're at a good point in time to really be investing in development, investing in specifically build to rent development. And I think the folks that do that in this time are going to do very well.
Yeah, and then, I know we're kind of coming to the end here, Ryan, and I just want to kind of wrap up and get some closing thoughts from you and, just a chance to reach out to our listeners, our investors. For you, if there was one piece of advice that you could give our listeners and our investors that might be considering getting into investing in the build to rent model, what would that one piece of advice, if you had one for some people listening, what would that piece of advice be?
Yeah, I touched on some of this earlier, but I think, look, relationships are important. People are important. It's people that execute these investments, and so you want to work with and partner with people that you trust and that you've got a good relationship with, and that have the track record and the experience of executing it. You don't want to be the first one to kind of experiment, with your investment dollars, right? And so I think when it comes to build to rent investments, historically, I would say, the smaller retail investors, they haven't gotten to do as much of this just because the projects are larger. They've tended to be capitalized with, large institutional investors, right? And we've done a lot of those deals where you just have one guy who writes you a $20 million check, and there's positives to that, right? But there's also drawbacks from our standpoint. So I think we're excited to be able to offer institutional grade build to rent investment opportunities to more direct investors to really get exposure to this great asset class that's has been pretty hard for them to access historically.
Yeah, I completely agree. And I think that's really a great point to wrap it up for today. I think you did a great job of really breaking down the build to rent model. And I think it really informed our listeners and our investors. And I think there's definitely going to be some excitement in this asset class in the near future. And then I think just the last question I would say would be, what's the best way to really get in touch with you or explore opportunities with Red River Development?
Sure. Yeah, you can find us online, just redriverdevelopment.com. You'll see a lot of information there. You can, schedule a call. Happy to talk to anybody. So that's a good way to find us. As I mentioned, Trulo Homes, that's our property management business. So you can see our communities there, and there's a lot of imagery there to kind of give you a feel for, what does this product look like? What's the resident really getting here? And so those are probably the easiest ways to find us.
All right, well, perfect. And Jacob, I don't know if you have any other closing remarks, but Ryan, thank you so much for coming on to today's episode and sharing a little time with us and having us pick your brain a little bit. And couldn't be more thankful. So thank you.
Thank you, Aaron. Thanks, Jacob. Really enjoyed it.